traders, this is your Forex market commentary brought to you by Real ECN. Today's commentary, we will touch base on the Aussie US dollar pair. Only second to the British pound, the Aussie dollar has become one of the best performing currency against the greenback so far this month. This is largely due to risk appetite continuing to have a strong grip on the market sentiment, coupled with a pickup in Chinese factory activities. Investors are looking forward to this Thursday's US non-farm payroll print to give the greenback a lift. I hope that these commentary will prove to be insightful for traders in forecasting and formulating a successful trading strategy. So first in line with this discussion, we will break down the commentary into two parts. The first aspect we will first explore is the technical front on the 1 hour chart on the Aussie US dollar pair. The narrative for the Aussie US dollar pair heading to this week trading session had made the Aussie one of the best performing currencies second to the British pound heading to the third quarter. A recovery in the Chinese manufacturing PMI print was the first trigger to this rally, followed by a disappointing Tier 1 US ISM PMI print with an absence of a dovish rhetorical from the RBA during yesterday's interest rate meeting. On an intra-month time interval, the Aussie is testing the 61.8% Fibonacci expansion set up at 0.9499 mark. If the pair can break above this resistance tier, this will expose the Aussie to the next resistance tier at 76.5% expansion at 0.9534. However, failure to test the 61.8% resistance level can reverse the pair back down to the 50% at 0.9471. Since the price action on the Aussie US dollar pair is trading at multi-weeks resistance level, analysts believe that entering to long position at this moment does not justify the risk and reward profile of the trade. Likewise, an absent of a bearish bias in the marketplace, analysts recommends hold position at present. According to the SSI, which is commonly known as the Speculative Sentiment Index, net retail open long position and net retail open short position on the Aussie US dollar pair showed that the pair is trapped in a congestive convergent pattern. Market sentiment indicate a neutral undertone with only 51% of these open positions are at long interest. Since volatility continued to remain muted in the marketplace, analysts believe that the pair is most likely trapped in the consolidation. Until volatility return, analysts expect that the pair is most likely consolidate at the 0.9300 to 0.9350 range. Analysis of a collection of technical indicators on the hourly time interval on the Aussie US dollar cross is suggestive of a temporary bullish market sentiment and recommend short positions on the greenback. The Aussie US dollar pair opened today's Sydney trading session 1 pip below the established Fibonacci support at 0.9486, while the Fibonacci resistance is set at 0.9498. The pair broke up from the 200-day simple moving average during Monday trading session and continued to trade above the 200-day simple moving average. This has allowed the market to continue to hold their long-term bullish outlook on the cross if it continues to hold above the 200-day simple moving average. The significance of the 200-day simple moving average cannot be understated, as 200-day simple moving average contain more or less of 1 year's worth of trading data. This bullish view is also validated on short-term moving average front, as the pair opened today's Sydney trading session above the 10, 20, and 30-day simple moving average, but below the 5 SMA, which is indicative of a buy recommendation on the simple moving average front. So moving on to the fundamental aspect of the Aussie US dollar pair, without a doubt, the most recent trading price action indicated that the Aussie has managed to rally against the greenback to a 7-month high after breaking out from its medium-term congestive trading range. One of the driving forces behind this rally is reflective in the equity market, which had made tremendous gain in recent months. One thing for sure is that risk appetite continued to remain strong at present on the back of the optimism shared by investors that global growth will continue to pick up in the third quarter. Since the Aussie US dollar pair is highly correlated to risk appetite, this low volatility environment has proven to be one critical component in driving the recent Aussie rally to north of 0.9400 level. One indicator that points to the notion that global growth is expected to pick up is the Chinese manufacturing PMI print. Recent PMI print showed that the last two contractive quarters in the Chinese manufacturing is bottoming out as the PMI tick in at 51.0. PMI reading above 50 is indicative of expansion. In addition to that, the Chinese HSBC manufacturing PMI print, despite ticking in below expectation at 50.7 when forecasts expect a 50.8 reading, it continued to pick up in Chinese manufacturing view. Yesterday, the RBA continued to keep its main refinancing rate at 2.5%. However, the lack of dovish reinforcement to its previous press conference helped revise the Aussie bullish bias. The RBA language was dubbed as being optimistic with regard to the Australian economy. Despite a slowdown in recent Australian manufacturing print, this was offset by a pickup in Chinese manufacturing report, and as Chinese factories activity continue to expand, this will ultimately benefit the Australian export market. On this week's trading calendar, the greenback entered this week with a pickup in housing market. In the housing market, U.S. pending home sale month-on-month expanded more than the market and has anticipated at 6.1% with expectations set at 1.5%. However, Tuesday's ISM manufacturing print fell below expectation by ticking in at 55.3 when forecast expects a 55.8% reading. The month of June has been a tough month for the greenback, with the inconsistency in U.S. Tier 1 and Tier 2 economic leading indicators rolling out. Investors see very little reason to be bullish on the greenback. 10 years long-term U.S. Treasury yield continued to fall to 1 month low, and with little reason to rise, since risk appetite continues to be the prevailing theme, coupled with a dovish Fed who is reluctant to move away from a 0% interest rate policy. Traders are looking forward to this Thursday U.S. non-farm payroll print to briefly give the greenback a short-term support. I hope that this commentary is useful to our traders, and thank you everybody for listening. Have a good trading week.